Welcome to Iron Financial. Our mission here is simple. We help you forge a stronger, more resilient portfolio. We do that by cutting through the market noise, the headlines, the hype, all the weakness. We don't chase narratives. We inspect foundations, piece by piece. Today, we're putting GE HealthCare directly into the crucible.
And when he says crucible, he means a full-scale, no-holds-barred stress test on their latest earnings report. Look, we're here to find out if this company is forged from solid steel or if it's got some hidden flaws that are about to buckle under pressure. So let's get this thing started and dive right in.
So, this is the central question we're tackling today. You read the press release, you listen to the earnings call, and they paint a very specific picture. It's a picture of operational resilience, of solid growth. The blueprints they're showing us suggest this thing is forged in strength.
Yeah, but we all know a fresh coat of paint can hide a multitude of sins. We're here to look past the marketing and inspect the actual structure. Are we talking about high-grade steel, or is there some cheap composite material that's destined to crack the moment real-world pressures get applied? I see the headline numbers, I see the beat, but headlines are one thing. The foundation, the actual load-bearing walls of this business, that's what really matters. We need to find out if this is a genuine opportunity or just a well-marketed trap.
And to do that, we've structured our stress test into 6 very distinct phases. First up, we're going to examine the architectural drawings. That's the headline numbers. Then, we're popping the hood. We're going to inspect the individual engines that power this thing, the business segments.
Right. And after that, it's the real pressure test. That's where we apply force and see how the structure holds up against things like tariffs and profitability squeezes. Then we'll check out the scaffolding they're putting up for future growth, see what Wall Street's inspectors are saying because they can't seem to agree, and then
we deliver the official no-nonsense Iron Financial verdict. Let's get to work. All right, phase 1 of the inspection begins now. We are looking at the high-level architectural drawings. These are the key results from the fourth quarter and the full year 2025 earnings report. This is our first top-down look at the company's overall structural integrity.
Okay, let's see if the numbers actually match the hype. I want to see scale, I want to see growth, and I want to see momentum. So let's start at the top. Show me the top line.
Here's the first pillar, and it looks solid. Fourth quarter revenue clocked in at $5.7 billion. Now, that translates to a 4.8% organic growth rate year over year. Hang on, let's just make sure everyone's on the same page. When we say organic growth, we're talking about growth from their core business operations. This isn't them just buying another company to make their numbers look bigger. It's a critical health metric. Exactly. And this is the crucial part. That $5.7 billion beat analyst expectations. The street was looking for something closer to $5.6 billion. So right out of the gate, they are demonstrating an ability to exceed what the market is forecasting. That's a clear sign of solid commercial execution.
It's a good start, but we'll see if that strength holds up as we dig deeper.
Okay, so let's zoom out from the single quarter and look at the entire year. For all of 2025, GE HealthCare brought in $20.6 billion in revenue.
Right, and for the full year, that works out to 3.5% organic growth. And management was, very quick to point out on the call that this was actually ahead of their own guidance. So what we're seeing here isn't just a strong finish to the year, it's a pattern of consistent performance that built momentum over 12 full months. Okay, I have to give them that. That's a point in their favor.
Now this slide, this number right here, is what you need to focus on. This is the cornerstone of the entire bull case for this company. They have a record backlog of $21.8 billion. That is up a full $2 billion from just the year before. A backlog of this magnitude is a powerful, powerful indicator of future revenue. It's like a massive concrete pillar supporting the entire structure.
And let's be crystal clear about what that actually means for everybody watching. Their book-to-bill ratio for the year was 1.07. For every single dollar of product they shipped out the door, they booked $1.07 in new orders. They are literally booking new business faster than they can fulfill it. That shows sustained, incredibly strong demand for their products. You can't argue with that. It's a very healthy sign.
Okay, whoa, hold on a second. Pump the brakes. The revenue growth is fine. That backlog is undeniably strong. I will give you all of that. But look at this table. My eyes go straight to this row right here. Adjusted EBIT margin. This is where the blueprint starts to show some really serious cracks. Just look at the fourth quarter. It dropped from 18.7% all the way down to 16.7%. That is a 200 basis point compression.
That is a fair point, but you have to consider the...
No, it's not a fair point. It's a critical one. And for anyone new to this, a basis point is just 0.01%. So we're talking about a full 2 percentage point drop in profitability in a single quarter. And for the full year, it's down 100 basis points. You can't just gloss over something like that.
Growing your top-line revenue is absolutely meaningless if your profitability is eroding underneath. That's not a solid foundation. That's a clear sign of significant stress on the entire structure. The real story is right there in the margins.
You're absolutely right, and we are going to put that margin pressure directly under the microscope in the very next section. But first, to really understand why those margins are under so much pressure, we need to move to the next phase of our inspection. We are now opening up the machine to look at the individual engines, GE HealthCare's 4 distinct business segments. Good. Let's see which of these parts are firing on all cylinders and which ones are sputtering and dragging down the performance of the whole machine.
Okay, so looking at this donut chart, you can immediately see the 2 high-powered engines here are clearly Pharmaceutical Diagnostics, which they call PDEX, and imaging. PDEX was an absolute monster this quarter. I mean, it posted a massive 12.7% organic sales growth. And imaging, which as you can see is their biggest segment making up around 45% of the business, put up a very, very solid 5.3% organic growth. These 2 are the workhorses, and they are driving that top-line beat we saw just a few minutes ago.
Okay, I'll concede that. Those parts of the machine are definitely well-oiled and running hot. PDEX and imaging are pulling their weight and then some, no question about it. But a machine, and a company for that matter, is only as strong as its weakest part.
And that brings us directly to the weak link in the chain, patient care solutions. I mean, this is a clear malfunction. As you can see right there on the left side of the slide, this segment is actually shrinking, it's contracting, with a year-over-year revenue decline of 1.1%. And what's worse, the EBIT margin for this segment was down 380 basis points year over year. You can't just ignore a major component that's actively failing like this. But you have to look closer at the slide. Look over on the right. Yes, the year-over-year comparison looks weak. I completely agree with you. However, on a sequential basis, and that means from the third quarter to this fourth quarter, the EBIT margin for this segment jumped by 530 basis points. That's not a malfunction. That is a repair in progress. Management said on their call this was due to higher volumes as they finally worked through a previous product hold. They are actively addressing the issue and turning this part of the machine around.
A repair in progress is one way to put it. I might call it a persistent problem. And this brings us to the absolute core of our stress test today. We've seen the blueprint and we've inspected all the parts. Now it's time to apply some real pressure to this structure and find its true breaking points.
And the single biggest external force that is hammering this company, which was mentioned again and again in the earnings report and on the call, is tariffs. So let's see exactly how the structure holds up when we apply that weight.
So let's look at earnings per share, or EPS. The company reported adjusted EPS of $1.44, which is the taller bar you see on this chart. Now, baked into that number is an estimated 17-cent impact from tariffs. If you strip that out, if you remove that external pressure, adjusted EPS would have grown 11% year over year. That's strong, double-digit growth, and it demonstrates the underlying strength of the core operation.
Strip it out? You can't just strip out a real-world cost. Come on, look at the shorter bar on the chart. That's the GAAP number, generally accepted accounting principles. That's the number that actually accounts for all the costs, and it's only $1.29. Tariffs are not some theoretical adjustment you can make on a spreadsheet. They are cold, hard cash flowing out of the business. You cannot build a sound investment thesis on imaginary, adjusted numbers. The pressure is real, and it's causing the earnings structure to crack.
But this is exactly what a strong management team is supposed to do. They don't just sit there and take the hit. They reinforce the structure against the pressure. And this is brilliantly illustrated by this quote right here from the CFO, Jay Saccaro. He states that they significantly mitigated gross tariff impacts. And the numbers actually back this up. For the full year 2025, they mitigated about 50% of the gross tariff exposure through strategic supply chain shifts and other operational efficiencies. This isn't ignoring the problem. This is actively fighting it and winning. It's a testament to their operational resilience.
Winning? Let's define winning. Look at this slide. The final scoreboard for the full year shows an adjusted EBIT margin of 15.3%, which, as we've already established, was down 100 basis points. That's a loss in my book. Management can talk all day long about how, if you just ignore the $245 million tariff impact, the margin would have actually been up. But you can't ignore it. That mitigation wasn't enough to prevent significant margin corrosion. So the crucial question is this. Is the company's profitability fundamentally weaker than these adjusted numbers are trying to suggest? Are they just using these adjustments to paper over a structure that can't actually handle real-world economic pressures? That's the risk here.
All right, we have pressure tested the current structure. Your points are valid. Now, let's look forward. We're shifting our focus from the building as it stands today to the scaffolding that's being erected for future expansion. A company isn't just what it is today, it's about what it's building for tomorrow. So now we're looking at innovation, strategic acquisitions, and their official guidance for the year ahead. Okay, let's see the framework they're presenting to the market. And the plan they've laid out is solid, it's well-engineered. Look at this three-pronged strategy they're executing. First, innovation. They've deployed over $1.7 billion into their innovation pipeline. This has resulted in them having the most AI-enabled FDA authorizations in the entire industry, 115 of them. They're also launching key new products like the radiopharmaceutical Flyrcado, and the proof is in their 55% NPI vitality rate, which means that over half their revenue comes from products they've introduced in just the last 3 years. Okay, strong innovation is absolutely critical in healthcare. I'll give them that. That's a solid point. What's the next prong? Second, smart strategic acquisitions. They announced the planned $2.3 billion deal for Intelerad. This isn't just about getting bigger, it's about getting smarter. Intelerad accelerates their push into high-margin recurring SaaS, that's software as a service revenue, which investors absolutely love for its predictability. And third, they're getting more efficient at home using their internal heartbeat system to improve backlog execution and delivery. This system drove a 25% average monthly improvement in their past due backlog in the second half of the year. This is a comprehensive, well-thought-out framework for growth.
And that framework translates directly into their 2026 guidance, which serves as the official blueprint for the year ahead. They're projecting 3 to 4% organic revenue growth. And look, importantly, check out the second row, 50 to 80 basis points of adjusted EBIT margin expansion. They are explicitly telling the market they are going to reverse the margin compression we've been debating. The adjusted EPS guidance of $4.95 to $5.15 represents 8 to 12% growth and was a solid beat versus what Wall Street was expecting. And a projected $1.7 billion in free cash flow shows the business is a true cash-generating machine. Hold on a minute. Let's not get carried away here. The EPS outlook did beat expectations. I'll give you that. But that revenue guidance of 3–4%? Stifel, a firm that's actually bullish on the stock, called it thoughtfully conservative. And why did they use that word? Because management is being extremely cautious on China, which is a massive market for them. You know, a conservative outlook on a key growth market isn't exactly a sign of booming confidence. It signals that there are still significant external risks out there that could slow down construction.
Well, a cautious outlook is a prudent outlook, especially in this global macro environment. But you're right, we at Iron Financial aren't the only ones inspecting this structure. Wall Street analysts are poring over the very same blueprints and financials.
And it is definitely worth noting that they've come away with some very different, almost polar opposite conclusions. The street is clearly divided on this company, which is exactly where you find either major opportunity or major risk.
So first, you have the bull case, and it's perfectly summarized here by Stifel. They see an impressive finish to the 2025 year. They see the solid foundation that's built on that massive backlog and the strong segments that we've already talked about. And they view that thoughtfully conservative guidance not as a weakness, but as a strategic strength. They believe management is setting a low bar that they can easily clear as 2026 progresses, potentially setting the stock up for positive surprises, what we call beats and raises, throughout the year. But then, right on the other side of the street, you've got the bears, and UBS is leading the charge with this call. They downgraded the stock from neutral all the way to sell, and their reasoning gets to the absolute heart of this whole argument. It's not just about the cracks we found in the margins, it's about the price tag on the whole building. UBS believes that even if the structure is fundamentally sound, the valuation is simply too high. It's like a well-built house that's priced like a mansion. At a certain point, the price itself makes it a risky investment, regardless of the quality of the underlying asset.
So, there you have it. The full inspection is complete. We've examined the blueprints, we've kicked the tires on every single segment, and we've pressure tested the profitability and the margins from every angle.
And Wall Street is completely split down the middle, so that means it's time for Iron Financial to cut through all the noise, weigh the evidence from both sides of the argument, and issue our final no-nonsense verdict.
And this is what it all boils down to. After running this company through our rigorous stress test, after seeing both the solid, reinforced pillars and the very visible cracks in the facade, what have we actually found? Is GEHC a solid foundation that presents a real opportunity to build on for the long term? Or are the margin pressures, the heavy reliance on adjusted numbers, and those serious valuation concerns just a structural trap waiting for unsuspecting investors to fall into? Look, the bull case, as you can see on the left, is clear and it's compelling. That record $21.8 billion backlog is a massive load-bearing wall of future revenue. The PDX and imaging segments are high-performance engines firing on all cylinders. Their innovation pipeline, with its leadership in AI and new products like Flyers Cardo, is building the framework for years of future growth. They've proven they can weather storms, and they're even returning capital to shareholders with a $200 million buyback. This is a solid foundation. But the cracks that you see on the right side of this table are absolutely impossible to ignore. The margin pressure from tariffs isn't some footnote, it's a headline story. The weakness in patient care solutions is a drag on the whole enterprise. The heavy reliance on these adjusted metrics to tell a positive story should make any serious investor at least a little bit wary. And that cautious China outlook, combined with the high valuation concerns from a major firm like UBS, means you are paying a premium price for a structure that is showing very clear signs of stress.
So here it is, the official Iron Financial verdict. GE HealthCare is not a structural trap. The foundation, which is built on that massive backlog and a powerful innovation engine, is indeed solid. However, it is a structure with very visible stress fractures. The cracks from the persistent margin pressure and the underperformance in the patient care solutions segment cannot and should not be ignored. Our final assessment is that GE HealthCare has a solid core, but it requires careful monitoring before any heavy capital deployment. It's a structure that needs to prove it can make some repairs before it's ready for a major position in your portfolio.
So the crucial data point going forward, the one thing you absolutely need to watch is this: the adjusted EBIT margin in the first quarter of 2026. Management has guided for expansion. If they deliver on that promise, it shows the repairs are holding. If they don't, well, then those stress fractures could be a sign of a much deeper, more fundamental problem.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.